Today, the US stock market continued to record impressive gains as all three major indices, including the S&P 500, NASDAQ, and Dow Jones, maintained a positive trend. Notably, small-cap stocks also broke out strongly and reached a new high for the first time since 2021. This development shows that investor confidence is gradually returning, especially in the context of expectations that the US Federal Reserve, or Fed, will continue to lower interest rates in the coming months. The main driver of the market remains monetary policy after the Fed made its first interest rate cut this year. Investor sentiment became more optimistic, believing that this could be the start of a new easing cycle. However, the market is not completely reassured because long-term bond yields, especially 10-year bonds, are showing signs of rising again. This could reduce the attractiveness of stocks, especially high-valued technology stocks. In addition to the macro factor, another important highlight comes from the wave of technology investment, especially artificial intelligence and indigenous, large cooperation and investment agreements in this field, such as leading corporations pouring capital into AI development, have contributed to strengthening the belief that technology is still the long-term growth driver of the market. This explains why the group with technology and AI stocks continues to increase, attracting strong cash flow from both individual and institutional investors. However, it should be noted that the current increase comes with risks. When stock prices rise too quickly, the market can fall into a state of overvaluation, which can easily lead to unexpected corrections. If negative news from the macroeconomy appears, inflation reports, employment figures, and consumer spending are still key indicators that investors are watching. Just a signal of increasing inflationary pressures may force the Fed to take a more cautious stance, thereby directly affecting market trends. In addition, the seasonal factor is also something that cannot be ignored. September is often considered a volatile month and not very favorable for stocks in history. Therefore, although the market is very active, experts still recommend that investors should be cautious, avoiding excessive euphoria. Overall, the outlook for the banking sector remains positive if the Fed continues to signal dovishness. Tech, AI, and small-cap stocks remain bright spots but come with the risk of a correction. Meanwhile, defensive sectors such as healthcare, consumer staples, or utilities could become safe bets if the market enters a slowdown.